As managers, we're expected to maximize shareholder value, which translates into maximizing the share price. And we do that by making good decisions, good long-term decisions, including making good investment decisions and then managing those investments efficiently. And if we do that, we should expect the stock price to go up. But what if a company makes good investments, manages those investments effectively, and the stock price doesn't change, the market doesn't recognize it? We would say that the market wasn't doing a very good job of incorporating new information. It didn't recognize that management's done a great job here for this particular company. We would call that market inefficient because it wasn't correctly valuing our stock. So we want to talk about stock valuation. Now, as we've discussed previously, common stockholders, because of the risk they're taking on, they expected to be rewarded for taking on that risk via cash dividends and or increasing share value. Some of the investors in company stock make their decision to buy and sell stock based on a desire or a plan to maintain a well-diversified portfolio. But other investors, they're more speculative. They have different motivations. They try to spot companies whose shares are undervalued, which means that they believe the company's shares are worth more than the current stock prices. So these investors buy shares that they believe to be undervalued and sell shares that they think are overvalued. In other words, that the market price is greater than the true value. But how does the market value stocks? Are the market values reliable? Are they meaningful? What does a market value even mean? To arrive at reasonable, reliable prices, we need the market for stocks to be efficient. So what does market efficiency mean? It means that economically rational buyers and sellers, so market participants, they use their assessment of an asset's risk and its expected return to determine its value. Now, think about the U.S. stock market, the New York Stock Exchange, the NASDAQ, or both collectively. Very competitive markets, and there's thousands and thousands of participants on any given day, and everybody's trying to do the same thing. They're trying to find good stocks and sell bad stocks. In other words, they're trying to beat the market. Imagine a world where all of a sudden there's no new information coming. Buyers and sellers would settle on a price via supply and demand, and we call that an equilibrium price. We've arrived at a price absent any new information. This is the price that the market determines. This is the market value of that security. But in the real world, new information is flowing in almost all the time, and stock prices are going to fluctuate continuously, reflecting that news and reaching new equilibriums constantly. Now, because so many people are highly motivated and have access to basically the same information, it's really difficult for anyone to beat the market on a consistent basis. And this general concept of being difficult to beat the market because you have so many motivated participants with the same information set, that's what we refer to as market efficiency. But is the market actually efficient? Can investors consistently beat the market? Or maybe if not all investors can consistently beat the market, are there some investors that can consistently beat the market? So one way we could kind of try to answer that question is to see how experts perform. So in the next section, watch the video and listen to the podcast.